Chapter 1. The Pitfalls of Beginnings, Breaking Bad Habits. The road to becoming a successful trader is often littered with missteps, and beginners are prone to repeating the same mistakes that countless others have made before them. While these pitfalls are common, identifying and addressing them early can save traders from unnecessary losses and mental anguish. In this chapter, we'll explore the most damaging habits and patterns that beginners adopt, why they occur, and how professional traders overcome them. Overtrading, the silent killer. One of the most pervasive mistakes among beginner traders is overtrading. This happens when a trader opens too many positions or trades excessively, often without a clear plan. The allure of constant action can be overwhelming. After all, the Forex market is open 24 hours a day, 5 days a week. The sheer accessibility of the market tempts beginners to always be in a trade, but professionals stress that overtrading is one of the fastest ways to deplete an account. Overtrading stems from several psychological triggers. Impatience. Many beginners feel the pressure to make it quickly. They believe every second not spent trading is a missed opportunity for profit. FOMO. Seeing a price spike or a sudden move often leads to impulsive decisions without proper analysis. Addiction to action. The thrill of entering and exiting trades can become addictive, clouding judgment and pushing traders to ignore strategy in favor of constant activity. The professional perspective. Experienced traders know that markets move in cycles, and not every moment presents a high-probability setup. Trading less, with precision and planning, often results in better outcomes. Professionals focus on identifying key setups and waiting patiently for them. They understand that trading is not about how many trades you take, but how disciplined and calculated each trade is. Revenge trading, the emotional spiral. Losing is an inevitable part of trading. However, for many beginners, a single loss can ignite a dangerous cycle of revenge trading, making impulsive trades in an attempt to recover losses. Instead of sticking to a plan, beginners often abandon their strategies, chasing wins and making increasingly irrational decisions. For example, a trader may lose 2% of their account on a poorly planned trade. Instead of accepting the loss, they double their risk on the next trade, hoping to recover the loss and make a profit. This emotional spiral often leads to compounded losses and eventually the destruction of their account. Why it happens. Ego. Many traders struggle to accept being wrong. Losing a trade feels like a personal failure rather than a statistical outcome. Fear of failure. Beginners often view losses as proof that they aren't cut out for trading, leading to panic-driven decisions. The gambler's fallacy, the belief that the next trade will make it all back, mirrors the mindset of a gambler trying to recoup losses. The professional perspective. Revenge trading is replaced with discipline. Professionals view each trade as independent of the last. They approach trading with a probabilistic mindset, understanding that even the best setups have a chance of failing. Instead of chasing losses, they focus on sticking to their plan and risk management rules, knowing that their edge will play out over time. The Holy Grail myth. Every beginner dreams of finding the perfect strategy, indicator, or signal that will guarantee profits. This search for the Holy Grail often leads to wasted time, money, and energy. Countless beginners spend months hopping from one strategy to the next, buying expensive systems or endlessly tweaking their indicators. Why it's a trap. Marketing and misinformation. The trading world is rife with advertisements for 100% win rate systems or guaranteed profit strategies. These claims prey on the desperation and inexperience of new traders. Lack of patience. Beginners often abandon strategies after a few losses, assuming the strategy doesn't work, without giving it time to prove itself. Overconfidence in indicators. Relying too heavily on indicators without understanding the underlying market dynamics leads to frustration when trades fail. The truth about trading. No strategy or indicator guarantees success. Even the most successful traders experience losing streaks. What separates professionals from beginners is their ability to stick to a proven system, manage risk, and stay disciplined regardless of short-term outcomes. Ignoring risk management. Risk management is the cornerstone of successful trading, yet it's one of the most neglected aspects among beginners. Many new traders focus solely on how much they can win, ignoring how much they stand to lose. This mindset often results in risking too much on a single trade, using excessive leverage, or trading without stop losses. Common risk management mistakes. Over-leveraging. Many beginners misuse leverage, risking a significant portion of their account on a single trade. Lack of stop losses. Trading without a stop loss exposes traders to unlimited downside. especially in volatile markets. Risking more than they can afford, beginners often put more on the line than they are emotionally or financially prepared to lose. The professional perspective. Professionals follow strict risk management rules. For example, they might risk only 1 to 2% of their account on any given trade, ensuring that no single loss significantly impacts their capital. They use stop losses religiously and never trade with money they can't afford to lose. This disciplined approach allows them to survive losing streaks and continue trading long-term. Lack of a trading plan. Trading without a plan is like setting sail without a destination. Many beginners enter trades based on gut feelings, random tips, or market noise. Without a structured approach, they are easily swayed by emotions, market volatility, or conflicting information. What a trading plan should include: clear entry and exit criteria, knowing exactly when to enter and exit trades based on objective conditions. Risk management rules, defining how much to risk per trade and where to place stop losses. Realistic goals, setting achievable profit targets and timeframes. Journaling, tracking trades to analyze performance and identify areas for improvement. The professional perspective. Professionals treat trading like a business. They have a detailed plan for every trade and review their performance regularly. This structured approach helps them stay consistent and make data-driven decisions. Final thoughts. The habits you develop as a beginner lay the foundation for your trading journey. Breaking bad habits early, such as overtrading, revenge trading, or chasing the holy grail, is crucial to building a sustainable and successful career. Professional traders stress the importance of discipline, patience, and risk management. By treating trading as a skill to be mastered over time, rather than a quick path to riches, you can avoid the common pitfalls and set yourself up for long-term success. As you move forward, remember, trading is a marathon, not a sprint. Those who focus on steady improvement rather than instant gratification are the ones who succeed. Chapter 2. The dark side of the industry. Scams, fake results, and the illusion of success. The forex trading industry is a breeding ground for scams and deceit, targeting beginners who are eager to succeed but lack the experience to differentiate between genuine opportunities and fraudulent schemes. In this chapter, we'll uncover how these scams operate, why they are so effective, and how to avoid them. We'll also explore the psychological impact of social media on traders, the rise and fall of prop firms, and the illusions that keep many traders chasing shadows. The rise of forex scams. The growth of online trading has opened doors for legitimate brokers, educators, and tools. Unfortunately, it has also created a perfect environment for scammers. These individuals or groups exploit the aspirations of beginner traders, promising them easy profits and shortcuts to success. Common types of forex scams. 1. Fake gurus and courses. The promise: scammers pose as expert traders who have cracked the code of the forex market. They often advertise expensive courses, mentorship programs, or signal services, claiming they can guarantee success. The reality: most of these courses offer generic or outdated information, and the individuals behind them rarely trade profitably themselves. Some even fake credentials or hire actors to portray successful traders. 2. Ponzi and MLM schemes. The promise: some scams present forex trading as an investment opportunity where participants can earn returns by recruiting others. The reality: these are pyramid schemes that collapse when recruitment slows, leaving most participants with significant losses. 3. Brokerage scams. The promise: fraudulent brokers lure traders with offers of high leverage, zero commissions, or guaranteed profits. The reality: these brokers manipulate prices, refuse withdrawals, or vanish with clients' funds. Signal groups and copy trading. The promise: traders are offered paid access to signals, or the opportunity to copy trades from a supposed expert. The reality: many signal providers have no real edge and rely on hindsight or luck to sell their services. How scammers target beginners. Emotional hooks. Phrases like financial freedom, quit your 9 to 5, or turn $500 into $10,000 in a month appeal to desperation and greed. Social proof. Scammers showcase fake testimonials, rented luxury cars, or fabricated trading results to appear successful. High-pressure tactics, limited-time offers, or exclusive memberships push beginners to act quickly without due diligence. The social media illusion. Social media platforms like Instagram, TikTok, and YouTube have become the primary stage for self-proclaimed forex gurus. Beginners often scroll through feeds filled with pictures of luxury lifestyles, exotic vacations, and screenshots of massive trading profits. These curated images create an illusion of success that is difficult to ignore. Why fake results are so convincing. 1. Photoshop and editing. Many scammers fabricate their results using basic editing software. They manipulate broker statements, profit loss reports, or trading apps to create fake screenshots. 2. Demo account trickery. Some scammers showcase trades on demo accounts while pretending they're using real money. 3. Paid actors and rented luxury. Exotic cars, mansions, and private jets are often rented for a few hours to create an illusion of wealth. The psychological trap. Social media creates a false sense of urgency and competition. Beginners feel they are falling behind when they compare their modest progress to the seemingly instant success of others. This leads to impulsive decisions, like purchasing overpriced courses, or risking more than they can afford in an attempt to catch up. How professionals view social media. Professionals know that genuine success is built on hard work, not flashy displays of wealth. They understand that real traders rarely post their profits online, as trading is a personal and private endeavor. Most importantly, they focus on their own journey rather than comparing themselves to others. The uncertainty of prop firms. Prop trading firms have gained immense popularity in recent years. These firms offer traders the opportunity to trade with company capital after passing an evaluation phase. While some prop firms are legitimate and offer a viable way for traders to scale their accounts, many operate with questionable practices. The prop firm model. 1. Evaluation stage. Traders pay a fee to take a challenge, where they must meet profit targets while adhering to strict rules. 2. Live funding. If traders pass, they receive a funded account and share a percentage of their profits with the firm. Risks and red flags. Unsustainable business models. Some firms rely solely on evaluation fees for revenue, rather than the profits of funded traders. This creates an incentive to set unrealistic goals and disqualify traders. Sudden closures. There have been instances where prop firms shut down unexpectedly, leaving traders without payouts. Hidden rules. Many firms have complex rulebooks designed to trip up traders, such as disqualifying them for holding trades overnight or during specific news events. How to identify legitimate prop firms. Look for firms with a proven track record and positive reviews from the trading community. Choose firms that generate revenue from funded traders' profits rather than evaluation fees. Read the fine print and ensure the rules are transparent and fair. The best defense against scams and illusions. 1. Do your research. Verify credentials, reviews, and the track record of any person or company offering trading services. Use trusted sources like community forums to gather unbiased opinions. 2. Ask the right questions. If someone is selling a course or mentorship, ask for proof of their personal trading results. For brokers or prop firms, confirm their regulation status and the security of your funds. 3. Focus on education, not shortcuts. Genuine trading success requires understanding the markets, developing a strategy, and building discipline. Avoid anyone promising guaranteed profits or shortcuts. 4. Trust your instincts. If something seems too good to be true, it likely is. Trust your intuition and walk away from anything that feels suspicious. The professional's perspective. Seasoned traders have seen it all: fake gurus, shady brokers, and fleeting prop firms. They know that the only path to success is through hard work, discipline, and persistence. Professionals don't rely on others to make decisions for them. Instead, they take responsibility for their education, strategies, and risk management. By understanding the darker side of the Forex industry, beginners can arm themselves with knowledge and avoid falling victim to scams. Remember, the goal is not to chase the illusion of success, but to build a solid foundation for genuine, lasting growth. As one professional trader once said, if someone is truly successful in trading, they don't need to sell you a course. They're already making money in the markets. The next chapter will explore what it truly takes to succeed as a Forex trader, focusing on mindset, habits, and long-term strategies that separate amateurs from professionals. Chapter 3. Mastering the Game. Building a Foundation for Long-Term Success. The journey to becoming a successful Forex trader is not a sprint. It's a marathon that requires patience, discipline, and a willingness to learn from failure. Many beginners enter the market with dreams of instant wealth, only to be humbled by the reality of trading. In this chapter, we'll explore the core principles, habits, and strategies that professional traders rely on to achieve consistent success. By adopting these practices, you can avoid the pitfalls that plague most beginners and set yourself on the path to mastery. The mindset of a professional trader. Trading is more than just executing buy and sell orders. It's a mental game that tests your emotions, patience, and decision-making under pressure. Developing the right mindset is critical to your long-term success. Key attributes of a winning mindset. 1. Discipline over impulse. Professional traders stick to their strategies and avoid emotional decision-making. They understand that consistency is more important than chasing quick profits. Beginners often abandon their plans after a few losses, leading to erratic and unprofitable trading. 2. Embracing losses. Losses are an inevitable part of trading. Professionals view them as the cost of doing business rather than a personal failure. They analyze losing trades to identify mistakes and improve their strategies, while beginners often let losses trigger frustration or revenge trading. 3. Focus on process, not outcome. Instead of obsessing over profits, professionals focus on executing their strategies flawlessly. They trust that consistent application of a proven system will yield results over time. Beginners, on the other hand, often measure success by short-term wins, which can lead to reckless behavior. 4. Patience is a superpower. Professional traders wait for high-probability setups and avoid overtrading. They know that not trading is better than forcing bad trades. Many beginners feel the need to be in the market constantly, leading to unnecessary risks and frequent losses. Building a strong foundation. Becoming a successful trader requires more than just technical knowledge. It involves creating a solid foundation that supports your growth and minimizes your risk of failure. 1. Education and skill development. Start with the basics. Learn how the Forex market works, key terminology, and the factors that drive currency prices. Master one strategy at a time. Whether it's trend trading, scalping, or swing trading, focus on becoming proficient in one approach before exploring others. Continuously improve your knowledge through books, webinars, and reputable courses. Avoid information overload by sticking to trusted sources. 2. Risk management. Risk management is the cornerstone of professional trading. Always use a stop loss to protect your capital and never risk more than 1 to 2% of your account on a single trade. Beginners often overlook this step, leading to catastrophic losses when trades go against them. 3. Start small. Begin with a demo account to practice your strategies in a risk-free environment. Once you're consistently profitable, transition to a small live account. Avoid the temptation to trade with large amounts of capital too early. It's better to make mistakes with small stakes than to risk significant losses. 4. Keep a trading journal. Document every trade you take, including your reasons for entering, exit points, and the outcome. Review your journal regularly to identify patterns and areas for improvement. Professionals use trading journals to refine their strategies and maintain accountability, while beginners often skip this critical step. Developing a strategy that works. A trading strategy is your roadmap to success. Without one, you're essentially gambling. Professionals rely on strategies that are based on logic, data, and proven principles. Elements of a strong trading strategy. 1. Clear rules. Define your entry and exit criteria, risk parameters, and the market conditions under which you'll trade. 2. Backtesting. Test your strategy on historical data to ensure it performs well over time. This helps build confidence and identify weaknesses. 3. Adaptability. Markets change, and your strategy should evolve with them. Stay open to tweaking your approach as you gain experience. The importance of simplicity. Beginners often overcomplicate their strategies by adding too many indicators or chasing the latest secret formula. Professionals know that simplicity is key. A clear, straightforward strategy is easier to follow and more likely to yield consistent results. Avoiding common bad habits. Breaking bad habits is as important as developing good ones. Many beginners unknowingly sabotage their progress by falling into these traps. 1. Overtrading. Driven by greed or boredom, beginners often take too many trades. This increases transaction costs and reduces the quality of their setups. Solution. Set a maximum number of trades per day or week and stick to it. 2. Chasing losses. Also known as revenge trading. This occurs when traders try to recover losses by taking larger, riskier positions. Solution. Take a break after a losing streak and reassess your strategy with a clear mind. 3. Neglecting risk management. Many beginners trade without stop losses or risk far more than they should on a single position. Solution. Prioritize risk management above all else. Treat it as your insurance policy in the market. 4. Relying on external signals. Beginners often subscribe to signal services instead of learning to analyze the market themselves. This dependency hinders growth. Solution: invest time in learning technical and fundamental analysis. The goal is to become self-sufficient. The best way to become a Forex trader. There's no single path to success, but professionals agree on a few universal principles. 1. Start with realistic expectations. Understand that Forex trading is not a get-rich-quick scheme. Success takes time, effort, and perseverance. Set achievable goals, such as improving your win rate or sticking to your trading plan for a month. 2. Find a mentor. A genuine mentor can provide guidance, share valuable insights, and help you avoid common mistakes. Be cautious when choosing a mentor. Focus on their track record and willingness to teach, rather than their lifestyle. 3. Focus on long-term growth. Shift your mindset from making money to mastering the craft of trading. The profits will follow as you gain expertise. Build a sustainable routine that includes ongoing education, regular practice, and periods of rest. 4. Surround yourself with like-minded traders. Join a trading community where you can exchange ideas, share experiences, and stay motivated. Choose groups that emphasize learning and growth over flashy results. Conclusion: trading as a lifelong journey. Becoming a successful Forex trader is not about luck or shortcuts. It's about hard work, discipline, and a commitment to continuous improvement. While the road may be challenging, it's also incredibly rewarding for those who persevere. By adopting the mindset, habits, and strategies outlined in this chapter, you can build a strong foundation for long-term success. Remember, the journey matters more than the destination. Trading is not just a way to make money, it's a path of self-discovery, growth, and mastery.